Hi everyone, welcome back to InfoCraze, your go-to channel for mastering finance and accounting concepts. Today, we are diving into something that's often tricky yet crucial for anyone attending a job interview for the position of finance assistant. We'll explore the key differences between closely related finance terms that are oftenly asked in the job interviews. These terms might seem similar at first glance. Understanding their nuances could be the difference between landing the job or missing out. So, if you are preparing for a finance interview or simply want to sharpen your knowledge, stick around till the end. Now, let's get started with our first question. What is the difference between budgeting and forecasting? Budgeting involves the preparation of a detailed financial plan that outlines an organization's expected income, expenses, and financial goals for a specific period, typically a year. It serves as a financial roadmap to achieve strategic objectives. It covers all aspects of financial planning like revenue, expenses, cash flow, and capital expenditure, setting up the financial targets and limits. It helps control costs and allocate resources efficiently. Budget is typically prepared for a fixed period, often 1 year, and remains relatively static unless there is a significant change in business strategy. Budget acts as a benchmark for measuring performance, whereas forecasting involves predicting future financial outcomes based on historical data, trends, and current business conditions. It is more flexible and focuses on updating expectations as circumstances evolve. It focuses on specific areas such as revenue or cash flow depending on business needs and provides a realistic estimate of future financial performance. It helps adjust plans dynamically in response to changing conditions. Forecasting can be done monthly, quarterly, or as needed, which is a rolling process that updates projections based on real-time data. Forecasting aids in decision making for strategy refinement and reflects realistic expectations rather than fixed goals. So now let's look into the key takeaways. A budget sets the baseline financial plan, while a forecast provides real-time updates to track whether the company is on track or needs adjustments. Budgeting establishes goals and forecasting ensures adaptability to meet those goals. Budgeting is about planning and control, focusing on what the organization wants to achieve, whereas forecasting is about predicting and adapting, focusing on what the organization is likely to achieve. Now let's take up the second question. What is the difference between cash flow and profit? Cash flow refers to the actual movement of cash into and out of a business over a specific period. It includes cash receipts, that is inflows from sales, loans, investments or other sources, and cash payments, that is outflows for expenses, loan repayments and purchases. Now let's look at the profit. Profit is the financial gain achieved when a company's total revenue exceeds its total expenses during a particular period. Profit is the surplus after deducting all expenses from revenue, irrespective of cash movement. So the difference is cash flow referred to actual cash transactions, inflows and outflows, whereas profit is an accounting concept that includes both cash and non-cash items. Cash flow measures liquidity and cash availability, whereas profit measures financial performance and earnings. Thus, cash received from sale or any other source is included in cash inflow, whereas revenue from a sale made on credit is part of profit even if cash is not received yet. The next question, question number 3. What is the difference between direct tax and indirect tax? Direct taxes are paid directly by individuals or organizations to the government. Example, income tax. These are imposed on income, wealth, or profits earned by individuals or entities and are directly paid to the government by them. Indirect taxes are levied on goods and services which are ultimately paid by the end consumer. These taxes are collected by intermediaries, example manufacturers, distributors or retailers, and passed on to the government. Question number 4. What is the difference between equity and debt? Equity represents ownership capital contributed by shareholders of a company, and it's raised through issuing shares to investors. There is no repayment obligation and returns depend on profits earned by the company. Whereas debt represents borrowed money that is raised by a company through loans, bonds or credit facilities. The amount needs to be repaid along with interest within a fixed period. Hope all these questions that we discussed till now are clear to you. Let's look at the next question. Question number 5. What is the difference between capital budgeting and working capital management? Capital budgeting is the process of evaluating and deciding long-term investments or projects that align with a company's strategic goals. It involves analyzing potential expenditures on assets like machinery, infrastructure, new products, or expansion initiatives which impact long-term financial growth. Working capital management involves managing a company's short-term assets and liabilities to ensure it can meet its day-to-day operational expenses while maintaining financial stability and efficiency. The primary goal is to optimize liquidity, profitability, and operational efficiency. Hope all these terms that we discussed today are now clear to you. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.